Hey guys, welcome to the newsletter for August the 20th. I'm recording this on the 19th, but I've got three good ideas for you. So let's jump right in. So I've got the S&P on the chart here to start with, just as a reference point. We hit the new all-time high last week. I believe that was on Thursday. Just up and away, right? And we seem to be having a little trouble getting really past this major level. There's actually a voodoo tree line right there. It's on a different chart, but it looks like we're having a little trouble getting there. I could easily see us pulling back to this 20-day moving average or the 50-day. I don't really see us going back this far down to the 200, but we could come back down and test some of these levels because we're coming out of earnings season. There's not a lot of catalysts right now. There's no Fed meeting in August. We do have a Jackson Hole summit coming up, but no Fed meeting, so no earnings, no decision from the Fed, things like that. Leads to a slow market, and again, this thing looks like it may want to pull back. So, and we've seen some violent pullbacks, violent moves up and down, right? A lot, particularly in semiconductors, things like that. So what I want to do with the three stocks of the week this week that I've got for us, I want to kind of go old school, right? And go something that we see this sector rotation that happens very, very quickly, right? So I want to go back to some of the old names that we know and like and all that kind of stuff and look at them. So the first one on the list here is CSX, the old stodgy railroad company, right? Now, it's funny, I've traded these railroads for 20 or 30 years. They've always been pretty stable, pretty consistent, pay a little dividend, have a little growth. But if you look at this, I mean, look at this. So CSX Railroad, right? Lower left, upper right, there's the 20. I mean, that is a great looking chart. It's only been below the 50 three times the whole year. And we've had the S&P, looks like this, some wild moves, so this can kind of, stocks like this can kind of stabilize your portfolio, especially in a downturn. Things rotate out of tech or some of the other sectors, and this has always been kind of a good defensive sector. Now, it is not in the same category as Nvidia or Micron or any of the other names, Apple, whatever, but that's not the point of this. The point of this is to get a good stable stock, right? So CSX is a good defensive name. So the earnings growth and sales growth on any of these defensive names is going to be a lot less than you would see in some of the aggressive growth names, especially tech type names. But the profit margin on CSX is 20.5% profit margin. That's pretty strong, right? It does have a dividend of 1.1%. You can see the yield right here, 1.1%. I want to highlight this because that is coming up on August 31st. You could still get this dividend as long as you buy it and it settles before 8/31. Now it's 14 cents, not a lot, but this is not a high dollar price stock. It's not a $600 stock. It's a $50 stock, right? So 1.1%, and this dividend, increases over time. So that is a good pick. The RSI is about 45. I like this. Again, this is a good candidate for a collar strategy, maybe selling naked puts. I've done that for years on this thing, selling naked puts and doing the wagon wheel approach, things like that, covered calls, things like that. So put that on the list as your number one stock, or they're not in any order, but that's the first one we're going to look at. The second one, again, I'm going old school here. How about this? Let's look at Coca-Cola. I mean, look at this. This has just been, the 1 year chart here. Let me get my drawing tool. Lower left, upper right, just what you want to see, right? There's the 20. We're steadily above that. Good, stable, old school brand, defensive name. Again, I'm kind of looking at consumer staples, consumer durables, not for the whole portfolio, but just to maybe sprinkle in a little bit in case tech gets weaker and all that. Now, to be fair, I'm not bearish. I don't think the market's going to have a black swan or anything like that. In fact, I think we do rally into the end of the year. So, these names will rally alongside those. It's, both these names, CSX and Coca-Cola, have moved higher all year long, with the market going up or down. So they're good names. As a point of reference on here, I went back. I actually highlighted this stock. I did a class several months back, and I highlighted this stock in particular, and we did a 10-year chart on it. Look at this. So this is a 10-year chart on Coca-Cola. You see our zone there, high to low. We have stayed for 10 years. It's done nothing but go up. That's why when you look at your 401k statement or an institutional portfolio, they're going to have some Coca-Cola in there. Those type names, right? But we're breaking out here. This is a really good sign. Maybe the next 10 years the zone is up here. So like that one a lot. It has an RSI of 48. Profit margin on Coca-Cola is 27.1%. That's crazy. Very, very good. Again, if you look at earnings growth and sales growth, they're not going to knock your socks off like some of these names I've highlighted in the past that have 300% sales and earnings growth or 600% or something crazy like that. But you're also not going to get that wild swing volatility. So consider that one as well. The third one, I just have to put it in here. We have to go back, get a little bit of exposure to oil, Occidental Petroleum here. Now, Oxy, I've highlighted over the last, year or so, a lot of the names, especially the little smaller cap drillers and oil service companies, things like that. Good place to be. Everything that's going on in Iran and the Strait of Hormuz and all that kind of stuff, these stocks going forward I think should perform better, I believe. Here's the 20 and the 50 have crossed over right there. There's the 20, there's the 50, there's the 200. We came and briefly touched it here. Great looking, straight up, kind of pull back, going back up again. This is another one that, over time has always been a pretty good stock to be in. So we do have a dividend coming up out here. Let's take a look at it. So on Oxy, we've got 1.86%, a little bit better. You would expect that on an oil and gas. They're one of the largest producers in the United States, and they're an international company. But 28-cent dividend goes X on 9/10, so you can still get this one as well. Again, we could come in and sell naked puts or covered calls or a collar, perhaps, things like that. Catch the stock, catch the appreciation, catch the dividend, things like that. I like doing that. I've done that for a long, long time, and I talk about that a lot in a lot of the videos that I do. But Oxy is pretty solid. So profit margin for an oil and gas company, 9.4%. Pretty good. Forward P of about 10.1, RSI of about 64. It does check all the boxes, so I do like that. And again, that is another one that would be more, I would consider obviously it's an energy stock, but it's I would consider it more in a defensive name or a stock that a rotation if some of these high flyers do continue to come down. So those are the three I have for you today. I hope that makes sense. Hope it helps. Take a look at those, see what you think. I hope you got the Apple that I highlighted in last week's video. It has really, really turned the corner here and started moving on up. We're about to clear. We cleared the 20 actually today. Really nice move today, up 2.19%, $6.80. So good move. Hope some of you got that. But let me know if you have any questions or comments, and also check out my YouTube channel. And if you're seeing this actually on the YouTube channel, check out and subscribe to the newsletter because it works both ways, right? But also come join me in the live trading room, and we do this stuff every day. So thanks for the time, guys. I appreciate it. Let me know if you have any comments or questions, and I will talk to you guys and see you in the next update. Thanks. Take care.